This is Mastering Your Wealth with David Gagnon, the podcast.
There's a new study, David, by Ipsos, asked financial advisors if they are adjusting retirement plans for this current economy. About 65% said yes. Many of them are using a strategy they never had before. That's an annuity. So what is something about the annuity that's appealing to retirees today, David, where maybe it wasn't necessarily the biggest idea 10 years ago?
Well, that is a great question because for many years, annuities were viewed very narrowly. People either loved them or hated them, and many investors did not fully understand where they were a good fit in their planning. Now, today, the conversation has changed because the retirement environment has changed. There's been a lot of changes, especially in the last 5 years, in the annuity landscape, the investment landscape. 10 or 15 years ago, many retirees were just relying on three things: their investments, maybe a pension, and Social Security. Now, today, far fewer people have traditional pensions. Now, I work with a lot of federal employees. They all have pensions, and their planning is going to be a little different. So the question becomes, where is the paycheck going to come from when the paycheck stops from working? And I get a lot of calls from people because they're struggling with creating that paycheck from their own resources when they stop working. And that's where income planning is so critical. And that is where certain annuities can be very attractive. So they can create a predictable income stream that is not directly dependent on whether the stock market is up or down that month. And for retirees who are worried about inflation, healthcare costs, taxes, and the possibility of outliving their money, the idea of a lifetime income can be very comforting. And so we always look at what is the threshold of lifetime income folks would like to have in their plan. And a lot of people feel very comfortable. They know what their Social Security benefits will be. We always put into great detail what their spending goal is, their spending budget. And a lot of times when people see that, well, their Social Security is not covering all the necessities, well, then we can increase their lifetime income with incorporating some lifetime income annuities so that they always know for as long as they live, their bare necessities are covered. And that usually leaves a good portion of their retirement nest egg available to plan for other things, longer term for growth, inflation hedges, maybe implementing some tax strategies or some healthcare strategies. And so annuities can be a great fit. They're not for everybody because not everybody needs them. Everybody's financial position is a little different. But if somebody has a large portfolio of dollars to live off of and their spending is well below their ability to earn a very conservative yield, they're not going to need an annuity. And people have to better understand what types of annuities are available to them because the word annuity is very general. And because there's immediate annuities, fixed annuities, variable annuities, indexed annuities, they're all different. Some have fees, some have no fees, some have risk. Variable annuities have high fees and market risk. We don't like using them. I don't think they're a good investment option for a lot of people. And for a lot of people that come through and do a variable annuities, we do a stress test analysis on that annuity so we can show them what their fees are and what alternatives would be more appropriate for that money. And so I think it's important to understand what choices you have, but build it into a plan and make sure that the benefits of an annuity are the right fit.
Yeah, you're exactly right. I mean, understanding your choices, understand how it fits within your plan. Again, this conversation started by you talking about how people are struggling to create a paycheck in retirement, and they're struggling to create this lifetime income. And a lot of folks are scared of the A word in retirement, annuity. And that's because, as you talked about here, there's many different kinds of annuities. They do different things for different folks. Some work, some don't. You know, different strokes, different folks, as they say. And this annuity stress test is a great opportunity to see where and when an annuity could potentially fit into your retirement income plan. Again, David, you've been doing this for over 3 decades. Much like everything, planning for retirement has changed. The strategies for planning for retirement has changed. The tools have changed. All that to say, annuities weren't the same as they were 20, 30 years ago, or when your parents or when your grandparents retired. So an annuity stress test is a great opportunity to see if and what type is good for you and your financial future. That phone number for an annuity stress test is 203-872-0009. That's 203-872-0009. The website, masteringyourwealthradio.com.
When you think about it, when you work all your life, what your end game is when you get to retirement is to accumulate enough money so that you can create an income stream from that. And what's much more predictable if you're using, say, an indexed annuity and you pay for an income rider. You know with certainty what that future income on that bucket of money will be at whatever age. And what's nice about it is you're not dependent upon the market performance to grow that annuity value that's going to produce that income, because there's usually an underlying guarantee that will roll up your deposit by, could be 7 to 10% a year. That might go on for 10 years or longer. But then when you get to retirement age, they give you a pretty high payout rate based on the account value or on that benefit base. That might be a distribution rate of 6 to 9%, depending on your age when you retire. And so think about that. If you're trying to do that with a market-sensitive portfolio and you're saving today, you don't know what that portfolio value might be in the future, because we could have some market corrections and you might get to retirement and not be able to produce a 6 to 9% guaranteed income for your lifetime from that market portfolio, because it just didn't work out with predictability and certainty. And a lot of times these lifetime income payouts come with what's called a multiplier. Like I said, there's been a lot of changes in the last 5 years with annuity benefits. And what that will do is, if you can't perform, and this could be a great backup healthcare plan. So if you can't do 2 activities of the 6 of daily living, which are your basic stuff, if your income guarantee is, say, $30,000 a year, they will double that for a minimum of 5 years for many of these policies, sometimes longer. So think about that. You're leveraging those dollars to protect more of your other money if you need to pay for out-of-pocket health care. And it's not a traditional long-term care insurance policy. It's just part of the benefit of that income guarantee. And so we look at these tools for backup strategies for healthcare planning as well. And if you never use the benefit, so you never had that health event, you still keep getting your lifetime income, and your cash account value could go to zero in the future, depending on how long you live and how much you've distributed out of the accounts. But if it goes to zero, you keep getting that income. It's like having a pension, and that's what pensions do. They make certain that you keep getting that income for as long as you're alive, and these plans can be built for both spouses. We do a lot of pension maximization strategies, so we can show folks that if they're going to get a pension from their employer, and they might have 1 or 2 decisions, and you could always make a mistake and not guess it. You can either take the lump sum out of your pension and roll it to an IRA and manage yourself, or take a lifetime income. Now, if you do the lifetime income, you give up ownership of that nest egg in return for the lifetime income. And if you pass away, and you can leave spousal benefits to your spouse, but if you pass away, there's no benefit or financial benefit to your extended beneficiaries. It might be your children. We show people how to build that plan so you get both. You get control and ownership of your cash, and you can have that income guarantee that might be as much as your current plan may be offering or higher, and also a doubler for healthcare, which that plan would never do. So that's why folks should see what is available to them before they make these important decisions to optimize their resources. Because with really good planning and the right financial strategies, the right financial tools, you can get more from your money and not take the risk you think you need to take. And this is why it's so important for folks to reach out to us, to take advantage of the free consultation, to have a discussion with us, and it'll be with me about what your concerns are, what your financial decisions you might be facing. And we can do the portfolio analysis and then have a broader discussion about the bigger plan and some opportunities that might be available to you to really enhance your resources, lower your risk, give you clarity as to how retirement could look, and implement it in a way where you can retire with confidence.
Absolutely. And as you talked about here, building a plan that gives you both control and ownership. How do you do that? It all begins with a conversation here. Give David a call today and set up your time for that consultation. Also being able to discuss your portfolio analysis. That'll be complimentary as well. We'll do it right now for you listeners today. 203-872-0009. 203-872-0009. And again, that website, masteringyourwealthradio.com. David, a lot of folks out there say, I'll just work a few more extra years to make retirement easier. But a survey by the Employee Benefit Research Institute found that plan often gets blown up by real life. They say nearly half of the people who retired in 2025 said they did so earlier than they actually expected. And 76 of those early retirements were due to things really outside of their control, like health issues, maybe layoffs, or even caregiving. So if someone is concerned about this and maybe they're forced into an early retirement, what are some moves they can consider now so they can protect their income?
Well, this is such an important point because I'll just work longer is not really a retirement strategy. It may be a preference, but it may be a goal, but life does not always cooperate, right? So health issues come up. I see this quite often. Companies are downsizing, and I'm seeing more and more recently. Spouse may need care. I have a number of family situations where you're seeing somebody needing to retire. And I got a couple of situations where that has happened in the last year where they retired younger than they thought to take care of their spouse. Parent needs care in some situations. That happens a lot. Sometimes the job changes, the stress becomes too much for some folks, or the employer simply decides the person is done for the position they have in their company before they are done. The person's just not ready. And so the first move is to plan for 2 retirement dates. One is the ideal retirement date that you would prefer in your mind. The second is the forced retirement date. And I call it the what if life happens earlier plan. And if you want to retire at 67, what happens if you're forced out at 62 or 63? Where does the income come from is going to be a big question. Do you have enough liquid savings? Would you claim Social Security early? A lot of questions. Would you draw from retirement accounts? What taxes would that trigger? Would healthcare coverage become a major issue before Medicare? And so the second move is to reduce fixed expenses while the paycheck's still coming in. Do a review and an audit of your current spending, your budget. If you have debt is dangerous in retirement because it creates pressure on your portfolio. You're going to have to disperse more to pay off debt. Credit cards, we look at car loans, personal loans, even mortgage decisions should be reviewed before your retirement. And the lower the fixed expenses, the more flexibility someone has if work ends unexpectedly. So, and the other thing is you want to really build flexibility so that if you are in a situation where you have to retire younger than planned, what you want to do is maybe you want to try to save more before that event happens. Do some catch-up contributions in your retirement accounts, do some Roth savings, get some cash reserves set aside, maybe build up a taxable investment that isn't locked inside a tax-deferred retirement account. I had a gentleman that came into us a while back. His plan was to work to 67, but he was forced into retirement at age 62 after the company had restructured. And right then and there, he was ready to start claiming Social Security at age 62, which you take a big discount on from what you would get from your full retirement benefit if you had waited to 67. He had to take 30% less of what he would have received at 67. So he was ready to claim Social Security because he felt he had no choice. So we reviewed his numbers, and we found that by using a combination of some cash reserves and conservative withdrawals for a few years, he could delay that Social Security decision and preserve that benefit to receive a much higher benefit in the future. And what we also did was we adjusted his portfolio so the early withdrawals were not coming from the wrong assets at the wrong time. And that planning made a big difference in his long-term income. So we put together a personalized strategic income distribution plan. So the answer is not simply save more. The answer is to build an early retirement contingency plan. And we help clients look at income sources, healthcare needs, because here's the other big question people have. If they are forced into retirement before they qualify for Medicare at age 65, that's a big expense.
Hundreds of dollars a month, yeah.
And so, that is a big planning expense that we need to incorporate into the income plan. And then decisions about when do you truly take Social Security to optimize that? How do you account and pay for taxes? If there's debt in the equation, how do we blast out that debt before you retire? And there's strategies for that. What kind of portfolio risk are you taking? And then what is the best withdrawal order to take your money to supplement your income? So because retirement should not collapse just because it starts sooner than expected. If you have a clear plan and is stress tested to retire younger or later, with clarity what's achievable. And then you don't have the financial anxiety that goes with the unknown because you don't have a plan. So we always talk about having a strategic, personalized, written plan that can adapt to changing environments, whether it's retiring at a younger age or needing to spend more because inflation is an issue, or higher taxes, or there's all kinds of things that will affect your money, and you should plan for it and stress test it in various different environments. So right now there's so much uncertainty. There's so many things that people are worried about: inflation, global events, the stock market being too high or maybe correcting. So if you're on the fence about whether you're confident to retire, give us a call. We can have that and discuss income planning, investment planning, tax planning. All these things affect your money. So give us a call if you're really looking for a comprehensive plan review and analysis. And we would do that complimentary for the first 5 callers.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.